Hey everyone, and welcome to vlog number 12, Lake Effect Investments. That's my YouTube channel. My name is Omer, and what I do over here is we track the performance of a stock portfolio that I started about 7 months ago, which comprises of small caps, tech, high growth stocks in biopharma, artificial intelligence, what do we got? Quantum computing and semiconductors in there right now. So we'll take a look at that a little later. We think, or I tend to think that those are going to be big things in the future. So that's kind of the play over there. And we do some discussions around macroeconomic factors, geopolitical stuff, and anything else that is of relevance. And this time round, the presentation is pretty packed with geopolitical, because that's just a big thing out there right now. It's big in the media, it's big in social media, general chatter, FaceTime conversations with people. This stuff keeps coming up and up and up. So I thought it'd be a good idea to share my thoughts on it. We'll probably spend a little bit more time on that. And I also decided to do a table of contents, which I think is a good idea. So for this time here, we're gonna talk a little bit about we're gonna do a little bit of rewind into history and talk about the world order and the trade order that came out of the Second World War, and that's very relevant, though it's hardly ever talked about in the media. It's actually very relevant, and I actually took a class in this, which wasn't required to, but I did it as part of my a function that I did in finance a very long time ago as a foreign exchange analyst. And because international currency exchanges and settlements is related to imports and trade, imports and exports and trade, and the settlements are done in U.S. dollars, so you were kind of required to have some background knowledge of how the system came about to be. So that's actually very interesting, and it's very related to what you're seeing around tariffs, and the breakup, the shakeup of this order that seems to be in play right now. And then also talk a little bit about, um, this whole thing that's going on with the government, with Doge, um, basically trying to cut down government, trying to do layoffs, and trying to shutter these agencies. And the idea seems to be to kind of move it into the private sector, and have that function as the primary and perhaps as the dominant engine of the economy, and to rely as less as possible on government to drive economic growth as well as to cut down the deficit. So I've talked about that in a previous vlog. I think it's in the vlog label, so you can go take a look at that if you want to. But yeah, that's definitely big. And then of course, we'll visit the stock portfolio and the stock market as well. Take a quick look at that. That has definitely taken a significant correction, um, and possibly more is on the way as the trade war just kind of seems to be taken off. But yeah, fear factor, blood on the street stuff is very, very real in the market right now. And we'll talk about that vis-a-vis our own long-term strategy with these stocks as well, with these kind of what are conventionally considered as high-risk stocks, and how that's playing out in this high-risk environment. Alrighty, so let's go ahead and jump in. Um, all right, rewind. World War II. Uh, so as everybody knows, the United States, had this America First movement that was going on over here as the war was going on, and it was a pretty influential, pretty significant movement. Um, Charles Lindbergh, the first guy in history to cross the Atlantic in an aircraft, in a solo flight. He was the main spokesperson of the. Where did he go? There he is. Oh, that's him. All right. Um, and it was an isolationist movement. They did not want the United States to get involved into the war, but eventually, Pearl Harbor happened, and you know, lo and behold, that ended that conversation. and the United States was very much in the war at that point. Eventually, we end up winning the war, and what happens in the aftermath is that mostly the Sino countries like Japan, Korea, etc., as well as Europe, who were more directly maybe engaged in the war. Of course, Europe was fighting Nazi Germany at the time, and Russia was fighting Nazi Germany at the time as well. Their currencies, their economies were pretty much shattered and very broken up at the point. So a new financial system or a new system or something had to be devised in order to kind of resurrect that and to get it going. And the United States having the largest gold reserves in the world at the time, um, was able to set the system up in an event called Bretton Woods. It was called the Bretton Woods Accord. Yep, and that was in 1944. So what they did over here was they said, okay, things are very tough out there right now. And the United States had still had a very vibrant economy. Of course, the war did not directly take place on U.S. soil, so there was an advantage over there. It had the largest economic engine. It's said that about, if not 50% of world GDP, something close to it, or something massive and significant like that. Um, and so since they had that, and since they had the gold reserves and everything, they would go ahead and they're gonna basically use the U.S. dollar, or offer the U.S. dollar to be used as a world reserve currency, which will be convertible into gold, right? Because gold is universally accepted exchange metal, I guess, yeah, or a currency, and it has been throughout history, and it's acceptable. And if countries want to start trading, if they want to start doing business with each other, they need to settle those trades, and you can settle them in US dollars, right? And that's why we have this world system of USD reserves, right? You don't hear about that so much here in the United States because it doesn't really matter to people over here. But when you go to, especially to the third world or to weaker economic countries, smaller countries in Asia and Africa, their foreign exchange reserves, which are mostly in US dollars, actually they are all in US dollars, is a key economic metric for them because that shows that how much capacity they have to conduct their trade and to do their imports. So that system was all set up back then, and the United States was also geopolitically kind of the leader of the free world. In this new Iron Curtain front that was coming up with the Russians, which was also an ideological front. You had the capitalist, laissez-faire, free world system on the west, and you had the communist socialist system on the east, right? So that's also coming up. The United States adopts the leadership role over there. That of course, was going to happen naturally, as it was the economic power as well as the military power at the time. And then it's setting up all these defense systems as well. Has a lot of bases around in Germany and Europe, and then you've got NATO as well, right? That keeps coming up a lot, and Donald Trump brings that up a lot, and he keeps saying that we have an unfair share of holding up that front or that defense system. But anyways, this is kind of the economic background to that, and with NATO and Europe and stuff, the system is now kind of 70 years old, and I think part of the narrative, which sometimes is not articulated as well, coming out of the Trump administration, is that Europe has now had 50, 70 years almost since World War II. It's an economic power very much today in its own right. It's got some of the largest economies in the world: Germany, France, United Kingdom. You can add up the others. Countries like Norway have built up a $1.7 trillion sovereign fund, and that means they have huge surplus, so they probably export a lot more than they import, and they probably have huge foreign investment or something else going on. But that's a very significant sovereign fund. So Europe should be picking up more of the cost of managing this front with Russia and playing more role and responsibility in military leadership as well as geopolitical leadership, which I think actually is a good idea in principle. And United States shouldn't have such a lopsided share of the cost of doing that. Um, Europe now has definitely built itself back up more than that. So that formula, that equation, yes, most probably does need to change. And also, kind of as a result of that, and this is pretty key to the discussion and the narrative around tariffs, which again is hardly mentioned in these terms in the media, is that the United States, with its economic engine and with its consumption habits, so right, American consumers are kind of the biggest consumers in the world. They'll consume a lot, even if it means piling up a lot of credit card debt, which it has now. It's over $1 trillion. Um, it was driving a lot of the economic engine around the world as well. So countries would import, I mean, export over to the United States a lot of its goods to be consumed over there, and we kind of took that in as part of the New World Order, and also these goods could be produced more cheaply around the world as well, for them to be brought over here and to be consumed. And I think it was kind of part of the geopolitical power order around as well, as the United States sought to yield more influence with countries in its sort of global ideological front and Cold Warfare with the USSR at the time, which eventually dissolved and kind of became Russia today. And so yeah, I think that covers most of the stuff over here. And so as part of that, if you look at this page over here, you'll see some stats and some graphs and some illustrations around the stuff that I talked about from the previous slide. So top left, you can see over here that, yeah, defense spending between the United States and the European Union, it's lopsided. And that's what the Trump administration is kind of harping on, is that, these equations need to change. We're not in that situation anymore. And given that that whole import-export dynamic that I talked about, that United States post World War II in the free world, in the capital world, is basically, taking in a lot of the production of the world, bringing it over here to be consumed by American consumers. There's a substantial amount of local production as well, but it did serve as this kind of global economic engine. And that's also kind of illustrated over here, right? When you talk about tariffs and counter tariffs and reciprocal tariffs and retaliatory tariffs, um, you can see over here that China, I mean, what the United States is importing from China, right? What China sells over here is nothing compared to the American goods that are sold over in China. So it is a pretty lopsided equation, and you'll see this kind of all over. You'll see this with Japan, you'll see this with Europe as well. And again, I think this whole breakup, this whole shakeup that's happening with tariffs and international relations and geopolitics right now also has a lot to do with this order, which, obviously the Trump administration feels that is not as relevant today, that it's kind of unfair, and it needs to change. And I would say that in principle, right, in principle, without getting into any political, taking any political sides or any ideological stuff, it is correct. It does sound right, that needs to happen, right? It may, as a result, not it most likely will result in lesser geopolitical influence of the United States around the world and with these economies and these countries. But that's what America First is, right? And that's what isolationism is. That it's like we don't want to be as involved in the world, and we want to take care of things at home over here. And maybe with the way the national debt is going, it's already at 37 trillion. That's the overall advertised number. If you take out all the intergovernment borrowings, all the left pocket, right pocket stuff, and paying Robin Peter to pay Paul stuff, it is, and there is an adjusted number over there. I guess I can just flash it real quick because I have it close by. This is what I shared in one of the previous vlogs. So yeah, if you take out intergovernment, state and local governments, Federal Reserve, that's all the internal borrowing that we do, the adjusted national debt. Um, so this is 2023, 33. So it's 37, maybe something like 24, 25, which is not as bad, but it's bad enough and it definitely should be addressed and taken care of at this point. So going back here, um, that is also at least in principle, on point. So with this world order that came up back then in World War II, and it does exist today, and it's the one I think that's being sought to be broken up. Uh, the arrangement was that as these countries are going to export into the United States, right? They're going to send their goods to be sold and consumed over here. They're going to generate a lot of income off that. But since they're getting that income off U.S. markets, where are they going to put that money, right? So that is going to run a huge deficit on the American side, but they'll go ahead and they'll fund that deficit as well, right? And they actually wouldn't have anywhere else to take it because there wasn't an economy as robust and as strong and as large as the United States that can take in those kind of volumes of funds. So on the right over here is an illustration by a website called Visual Capitalist. Pretty good. Check it out sometime. And you can see over here different sections of the world holding different U.S. Treasury debt. Japan being the biggest creditor, buyer, 1.1 trillion. China, pretty much up there at 0.9 trillion. And then if you add everything up, it's obviously it's a pretty massive number, but this kind of illustrates that part of the equation that, okay, you can bring your stuff over here, you can sell it over here, you can build up your economies, we'll maintain this geopolitical front and the strength against the Soviets, the Russians, the communists, and the socialists. And as a result, you'll fund this deficit, you'll fund this consumption and this economic engine and maintain the funds over here in US treasuries. But there's going to be prosperity for everybody to go around. So that's what's going on. And that's what I think Donald Trump feels and his administration feels is kind of playing unfairly in the United States, and that it has to break up at some point, right? Which is true. Wherever you are on the political side, this stuff has been talked about a lot in the past. Nothing has been done about it. And even though things are really shaken up and there's a lot of uncertainty and there's a lot of instability, that was always going to happen, right? And maybe, you can always talk about the modus operandi in the way and the manner that it's being done and have your opinion about it. But I'm just talking about economic principles over here. So it is, in that regard, pretty much on point. Okay. So the next thing on our agenda, sorry about that. Somebody's walking around. Um, sorry. The next thing on our agenda is tariffs, all right? Yeah, so let's talk about tariffs. Um, so what are tariffs, all right? I'll make this real quick. Um, tariffs are a way to manage your import-export equation, which is also called the balance of payments, right? It actually does have a core trade management function rather than just being a weapon of trade wars leading to real wars. And then basically the kind of stuff that tariffs is meant to do is like it can protect local manufacturers from foreign competition. It can make competition more equitable for your manufacturers and your producers locally at home and neutralize natural advantages and things like that. So for example, if somebody's exporting goods to the United States and they have a very unfair advantage in terms of, the resources that they need to do that are right next door, they don't have to build expensive extended supply chains to pull the materials together to make that product, and they can get labor much more cheaply than manufacturers can over here in the United States. So they have huge natural advantages, and by applying tariffs you can try to neutralize that so that competition is more equitable, right? So it does have these kinds of core economic functions as well. But this, yeah, it is geopolitically driven as well a lot of the time. Um, but one important thing to note over here, um, especially when when you're talking about, and sometimes when the president is talking about, that there are import levies and tariffs which are very unfair on the United States by countries that export goods over to us. They don't offer the same kind of terms to our exporters. Well, actually, there is a pretty sound reason for that, and it has to do with that history that I just talked about. Um, and the reason for that is that a lot of these weaker economic countries, um, as well as some of the stronger ones, maybe like South Korea and Japan, and some of the European ones, they're still kind of lingering on with these old policies set from World War II. But at least initially, they wouldn't have had the economic strength to take in a lot of imports because they would tax their reserves, right? So every time they're importing, they're holding US dollar reserves, and they have to settle those imports with payments from those reserves. So the reserves would go down. So they would want to protect from that happening. And anytime there's like a huge import happening, or somebody wants to import an automobile from another country or from the United States, they would have to pay huge import levies and tariffs on that to discourage that kind of thing, because it would lower their reserves, and their reserves would be very critical for them to import critical materials like fuels, food imports, and things like that. So it was a natural consequence of the way that whole economic order was set up from the World War II. I hope that made sense. But basically, what that means is that you know they would they would have to protect those reserves. And if they would run trade deficits, right, which a lot of these countries do, then you had the World Bank and the International Monetary Fund, the IMF, and there's a lot of conspiracy theories stuff, and negative narratives around the World Bank and IMF as predatory lenders, and debt trappers and things like that. But their function was that if there are trade deficits, they can fund those deficits, and they can help out with foreign exchange reserves, and the countries be given time to fix their balance of payment issues. But if those kind of problems prolonged, and sometimes you see corruption in these countries, and it just gets worse and worse and worse, and it leads into debt burden situations. So that's kind of why these levies and these tariffs exist on the other side. But again, continuing with that order forever is not a thing as well. It has to break up and reform at some point, and resetting it is going to be it's going to be tough. So basically, what's going on right now is that if the United States is saying, okay, we're not going to we're not going to play on with this anymore, you have to give us the same kind of trade terms that we have, which means your reserves can get can deplete quite a lot, because you'll have to import, and our products will become more competitive in your economies. Then if they have to go ahead and do that, and that is going to be an issue for them, they have to work it out, right? And it can be worked out. It's definitely doable, because they'll have to maybe redo their trade relationships, settle in different currencies. They can take up the euro, they can take up the yuan, they can go with their main trading partners, maybe build up some gold reserves themselves. I don't know how doable that is. But anyways, the USD world domination in international trade has been talked about for a long, long time. That people don't like it, and they don't think it's fair. It's a very dominant system, and there should be alternatives for people, and it also gives the US a lot of political leverage around the world as well, maybe a little too much. So you have those kind of narratives, and now is a good time to do that, to change that up, and to do something else with it. It's going to be tough. It's going to be hard. Redoing economic relationships and trade relationships does tax your resources and your wealth, and your economies and your manufacturers and everything. But that's what people have been talking about wanting to do for a very long time. and it probably is not possible to kind of continue with this order, and for the United States debt burden to keep getting bigger and bigger and bigger, which I think it just happens automatically as a consequence of the system. Um, so that has to happen at some point as well. And there's of course geopolitics around that as well, right? So when you have a system like that, like I just said, that it gives the United States huge leverage, and now China, has really come up the curve with its economy and its economic engine and its influence, and it's got this Belt and Road project around the world as well that it implements with countries and makes huge investments to build up infrastructure over there and trade with China. So there's geopolitics around that. It looks like China is kind of very forward in that way, and at this point in time, looks like the U.S. is going to be more on a retracting withdrawal, kind of this, not isolationist, I would say, but in a more of a withdrawal stage in this system. So it's fluid right now. It's very, very fluid. Nobody knows where it's going. Nobody knows exactly where it's going to settle. Um, I don't think the United States can just in a whiff give up its leadership of the so-called Western world or the free world, and let China have its way around the world. But let's see. But at least in an economic sense, that's kind of what's behind all these tariff narratives and headlines and trade war stuff that we keep hearing day in and day out. Oh yeah, and then this last point. Uh, Also, so modern international trade is not the same thing as what it was even 20, 25, 30 years ago, right? Let alone World War II, which is now 70 years old. Um, Back then, it was far more simpler to use a tool or a function like tariffs to address balance of payment issues, import-export issues, and make things happen, right? Be able to address things. Today, it's far more complex because logistical supply chains are global, they're sprawling, they're really complicated, right? If you put in tariffs to protect local manufacturers like General Motors, like Ford, they have international supply chains which bring materials into the United States in order to manufacture their automobiles over here in the United States. And some don't, as Tesla is being reported, right? That they're mostly American supply chains. Ford is also talked about as a more sheltered from these international supply chain logistics than some other automobile manufacturers. And I bring up automakers because that's big in the media right now. And that's where a lot of the hit from tariffs is expected to take place. Everything else is going to get impacted as well, and the impacts are also not. I don't think that they're very well understood at this point. A lot of it is speculation. A lot of it is very fluid. Uh, but yeah, um, it's not as easy as saying, okay, we're going to put tariffs in, we're going to be able to kill imports, and local manufacturing is going to go up as a result of that. Although there's actually stuff going on, which I'll share later, to that effect, where people are coming up to make investments in local manufacturing, and I think that's being done alongside all this. So I think it is being addressed, perhaps in the way that it should be, but to do it specifically through tariffs in a very knee-jerk way, in a very cowboy style, is probably not the best way to do it. But anyway, that's the idea. That's kind of the economics behind it. And kind of one thing that I wanted to share about tariffs as well is that tariffs is not a one-to-one, right? It's not as easy as you're going to put 20% tariffs on something, and it's going to mean 20% higher prices for the consumer. So in economics, there is something called the price elasticity of demand, which basically means that if you change the price of a product, how that's going to impact the demand for a product, right? So inelastic would be something where demand is not going to change so much. So you take essential items like fuels, energy, and groceries. There, the margins are usually thinner, and there is less capacity to absorb higher tariffs. So they do usually get passed down to the consumer. But in other areas, like luxury items, like automobiles, and of course automobiles has its own scale. You have essentials versus luxury versus sports and all that. So it works very differently in different sectors of the automobiles. But over there, for example, if you take something like luxury automobiles, um, you can take something like, I don't know, a BMW 3 Series, which is between, I don't know, 40 and 50K. And BMW may have um, analytics showing that, if they reprice that up to 55, 20%, okay, so let's go to 60, it's going to kill demand, right? They're going to go and they're going to buy a Cadillac instead. And they don't want that to happen. They don't want to lose the customer base off of something that may be interim, that could be short term or medium term, and they may look to do something a little bit different. So they're going to try and work hard at absorbing 20% of those tariffs where they can. So they may look at just becoming more efficient, less administrative expense, less selling expense, less advertising expense, more layoffs, something to absorb that into. Maybe they have some other levers they can pull, and usually large corporations can, and kind of minimize that tariff impact to the consumer as possible. Keep it maybe down to 5% or something so that they don't see huge changes in demand. And the thing is, if they were to pass those tariffs down to the consumer anyways, they could end up losing more than if they don't. So if demand drops substantially, right? Like as I said, if the price of a BMW goes, a 3 Series goes from 50 to 60K, and I don't know what the comparable thing is on Cadillacs on the other side, the comparable model, but if too many people are going to go over and buy Cadillacs, then it actually hurts them. So right, so they may even not want to do that. Absorb as much of the tariffs as possible. Take a hit on margin, take a hit on profits, but still do better than what if they were to pass tariffs. So those kind of dynamics do exist, and they're very complicated. They're impossible to predict. And like I said, even Cadillac could have a lot of import tariffs as well because they may be importing supply chains from everywhere. So there's more narrative around that. We've seen things like this in the past where certain manufacturers, certain sectors, certain corporations are going to be fully exempted from tariffs because they're producing an American brand, and most of the production and assembly and distribution takes place here in the United States. So that kind of thing could also happen. So it's not one to one. It's not as easy to say that, hey, it's going to be crazy bad for everybody. All right, I don't think so. I think it's gonna get rationalized. The worst part of it is, I mean, the thing that's worse than high tariffs is not knowing what the tariffs are going to be, right? If they're going to be 20%, 30%, how much retaliation is going to take place, how much of this reciprocal cycle is going to keep happening. So once the dust settles down on that, which hopefully it does soon, we can go to work to figure out what needs to happen from here on, right? How much of that do you pass to the consumer? How much do you not? What you can absorb, what you can't, how much of demand can you afford to lose or not. So all that I guess is yet to come. All right, so let's move on from tariffs and talk a little bit about the government, um, Doge and layoffs and agency shutdowns and that kind of stuff. Okay, so public sector, private sector stuff. Um, so yeah, one of the reasons that we've been running up this huge federal deficit, which is up to 37 trillion now, everything included, including internal borrowings, or even if you adjust for that, like I just showed, I guess I'll show it again. Right, 23 figures. So let's say in 25 is like 37. I think that's the number that's shown the most in the media. You take out all the intra-government stuff, Federal Reserve, local and state governments and things, and it's adjusted down to adjusted by a good 30%. So you could do 37 and 30. You'll still be in the, you'll be somewhere in the low 20s, I guess. So it probably is not as bad as it's made out to be. Uh, if you if you go back and fix stuff like a lot of intergovernment is Social Security, right? So Social Security collects retirement money from taxpayers to pay to retirees, and as retirees are ballooning and ballooning, um, that system is getting taxed, and if the government doesn't have the money to pay it back, what are we going to do? We're just going to have to learn to live with less, right? It's going to be bad for retirees, bad for economy, bad for consumption, but it is what it is. So uh, that's been going on, and the government public spending can be a major driver of economic growth. That tends to happen a lot around the world, in different countries, in different economies, and sometimes when economies and countries are coming out of recessions or crisis or something bad's going on, governments sometimes will step in and do infrastructure projects and other kinds of things to spur the economy back into action. So you can restore confidence and you can restore consumer spending, and private sector can get back into shape. Over here in the United States, I think over the last few years, we've kind of been very hooked on to this government spending and allowing it to just keep not running off, I would say, but just kind of keep chugging along and doing its thing in the economy, even though the private sector is pretty big, it's pretty robust over here. But this has kind of just added on and on and on, and it's ballooned the national debt, so it does have to be addressed. And you're seeing this stuff like reduced layoffs, shutting down government agencies, higher tariffs. So that is supposed to help out with national debt, and then bringing production back to the United States. But the good thing, right, when you do this stuff, it is definitely disruptive, right? It's always going to be disruptive when you do this, and when you unhook yourself from some kind of opiate, or yeah, I guess that's one word for it, right? Or a drug or something, and you're going to try and learn to walk on your own and to do things differently. There's going to be a wobbly, shifty, kind of unstable period to do that, and it's going to hurt the bottom line, and it's going to hurt your wallet. But eventually, your plan is to come out of it better, come out of it stronger, and to stave off a bigger crisis. So hopefully, this is happening when things are not as bad and not as frail. And I think from that perspective, at least to my eyes, it looks good. Not good, but it looks okay. Unemployment is at historic lows, right? So 4% to 4.5% is still okay. Yes, it's going up. More people are falling into the net, but it is still at historic lows. GDP has been coming down quite a bit recently. It's not great right now, but it's doing okay. We can go negative in the interim. It's gonna be an interim thing, right? Um, so it's not the end all and be all. So GDP is also doing okay. And also, as I talked about before, in previous economic and financial crises, like the let's say the internet bubble back in 2001 and the 2008 mortgage crisis, there was a lot of fraud and systemic problems, right? I won't go into details, but it was major in the system, and the financial system was not as strong. I probably should add that over here as well. Um, Regulation. So I'll talk about that in a second, and I'll keep it short, hopefully. Yeah, so no major frauds like we saw back in those crises. There is better what's known as CCAR regulation, which is having the banks especially hold a lot more capital and more cushion and more security on their balance sheets if things do go topsy-turvy. And there is systemic risk, and there's runoff, and people are going crazy. They're selling out of stocks. They're jumping into bonds. They're pulling their money out of banks that they deem weak. That kind of stuff happens. There is better regulation in the system to be able to address that. So if there is the time that you want to do this, right, and you want to do this in kind of a more of a hard-headed way, um, which is how I guess it's happening. Um, this wouldn't be a bad time to do it. This definitely would not be a bad time to do it. And you know, kind of more of something on the positive side. Um, Here's some news items, right? So it talked about tariffs, kind of breaking up with this world order that came up with the Second World War and trying to do something more America first now, and get Europe to pick up more of its weight, get other countries to rehash and reform their trading dynamics so they're not as dependent on the U.S. dollar as they have been. There's actually a lot of there's at least a lot of the news about investments coming into the United States, right? From a lot of these. So you've got Apple that's investing 500 billion over the next few years. The United Arab Emirates. So that's another economic dynamic that is probably should have wrapped it in here, but if we go back to this real quick, right? That's these guys over here, Saudi Arabia, UAE. This is just their holding of the national debt, but they actually also generate the ex they drill and refine and export the oil to the United States and to economies around the world. And this is not a more of a World War II thing, but it's kind of more of a World War One thing. But that system and infrastructure was also kind of developed and set up under the auspices of the United States back then. And they also do maintain a lot of their export surplus in the United States, not always in the form of these bonds, but a lot of it goes into real estate, a lot of it goes into stocks and some other areas as well. So you've got that dynamic that's going on as well. And where was I? Here. So this is where this is probably coming forward. That's about 1.4 trillion, right? So they want to put that money into AI, into semiconductors, and we have semiconductor stock. So it's one stock. Hopefully it catches that wave, right? It's not going to happen anytime soon, I don't think. But that's okay. And then Hyundai is also doing a lot of investment. 21 billion is what they've announced. So there's probably more of this stuff coming down the road. So it does appear that this is the playbook. This is kind of what's been set up, and it's being implemented. And you can have your opinions about how it's being implemented and the fashion in which it's being implemented. But ideally and in principle, it does look like it's the right stuff, and it's on point, and it is good to see it in action finally, right? After probably a decade, at least a decade of just sitting on this stuff and allowing things to get where they are. But in all fairness, we had the pandemic. Things happened, things were going on, but seems like now's the time. But let's see where it goes. Well, let's see if they're able to do it, and let's see how they're able to do it. Okie dokie. So let's move on to the stock market. I think I've gone long enough. Yeah, I don't even know what this is clocking in at, but it's probably on the higher side. So I'll try and move through some of this stuff a little faster. But stock market wise, nothing's going to be news here to anyone. So yeah, geopolitical nuanced risks. I'm talking about nuanced basically because this is not a risk that generally you think about, you talk about, where the global world order is changing around. So it is nuanced. And I think that's why the stock market has taken more of a hit, why there's more fear. All this stuff, trade wars, tariffs. So I'm not going to harp on that too much. The tech AI business case discussion is going to be a little subdued right now because a lot of this very dynamic macroeconomic and geopolitical stuff that's going on. But yeah, everything is down. The stock market is down. Consumer confidence is down. Inflation is not. Inflation is up. Um, and the Federal Reserve is going to hold straight rates elevated for longer, probably just to make sure that inflation doesn't come back in a bad way. And stagflation is now also being talked about, right? So what is stagflation is where you get higher unemployment because there's a lot of people coming into this, with all these government layoffs. And then at the same time, you're also going to have higher inflation driven by the tariffs. So generally, the two are supposed to be in opposition, meaning that if people spend less, there's higher unemployment, there's less demand, and so there's going to be less price pressure, and you can tame inflation, and vice versa. But right now, it's the dynamic is, again, it's nuanced in a way that you could see both sides of it. But then again, a couple of things that have popped up in this area is that the Fed the Fed probably in this situation cannot continue to view 2% as a legitimate target for inflation at this point, and they may revise that to something like 3%, maybe even 3.5%, because things are just too dynamic right now. And also, this is not demand-driven inflation, right? This is not inflation that's coming up because there's a lot of demand for goods and services, because consumer confidence is really high, and because unemployment is really low. It's the opposite. It's exactly the opposite, right? It's higher price pressure coming in from tariffs, from levies, those kinds of things, and it's not really related to demand. So maybe they could even lower interest rates, and I think the Trump administration is pushing that line that they need to lower it. But these guys are pretty good with their analysis and their analytics, and they understand economics a lot better than I do. Hopefully they're on top of their game, and it's one of the main levers that the administration doesn't have it. I mean, it's with the Federal Reserve, which is supposed to be independent from the administration, but they want it. I guess they want to have that lever, and they want to lower interest rates. A lot of fear factor, right? Because of the uncertainty and how bad the levies are going to get and how bad inflation is going to get. So you got all that going on, and subsequently the portfolio is definitely going to take a hit because of that. So we are. Let me just pull this up. We're doing all right. Um, I'll just quickly talk about a couple of things. So, whereas it's never fun to see your portfolio fall. So this number was, it peaked at 53% of gains, right? And it's now down to 7.4, and that happened in a pretty short span of time. But we're still beating the Dow, the Magnificent Seven, the S&P 500, and the Nasdaq by a very significant margin. We're still above the long-term bond rates, so it's still performing well vis-a-vis the competition. Although in real dollar terms, it's not as well. But again, this is a short-term flux, right? This is interim. It's unrealized, which means this is not the final outcome, right? I've talked about long-term investing before, and the reason for long-term, and this is it. It's basically because we're never going to fully know what kind of an economic cycle or recession or economic contraction, GDP, that kind of stuff that we're going to get into. And it's going to be cyclical, it's going to come and go, and hopefully there will come a time, hopefully not in the not too distant future, where all this stuff around tariffs settles down, and consumer confidence and spending and all that stuff that drives the economy, and interest rates and all that, it can change very quickly, just like it changed over here very quickly. And again, this is not really so much as the outcome, it's basically saying that the outcome is going to be very bad, right? So it's a fear factor, right? And as the saying goes, when there's blood in the streets, buy property, or rather buy stocks. And I did talk about that in a previous vlog as well, that we are holding on to liquidity for buying more if things go down, because we're in it for the long term, so we can wait for when the cycle restores itself. And when specific things happen that we expect to happen in the future, like for example AI, and semiconductors, EV industry that I've talked about a lot before. So what happened over here was that charge point, right? So with all this going on, EV industry already pretty suppressed, stressed, and then even more stressed now. So able to pick up charge point at 59 cents. I guess I'll talk about ChargePoint in a different vlog, I guess, if I ever get to it. But it's a pretty good EV charging company. Has a very significant sprawling network in the United States, and it's got a lot abroad as well. That's kind of on the plus side. On the minus side, its charging infrastructure is not as good as some of the other ones. Like EVgo has a much better one. Blink Charging, I think, is more or less around the same. There are a couple of other big EV charging companies. These guys are still on L1s and L2s, which means that it takes about a pretty long time to charge a car on those chargers, especially when you're on the road and you're on trips. And they will require more infrastructure investment to upgrade their EV chargers. Um, so, but again, it's all factored in, right? That's the reason why the stock went down all the way to 59 cents before it came down to came back up to 65 cents. So we picked up some stock over here. We think it's gonna be a key player in the future, in the EV industry growth in the future, and should provide us with some good returns, even if we see more capital issuance, more stock issuance, more dilution, concepts that I've talked about before that we don't have the time to get back into right now, and has more stress in the short term. Hopefully, this will be a long-term thing. And then we are looking into picking up some more during this dip. Um, I think there's more tariffs being announced today as we speak, as I speak, and Liberation Day, right? Liberation Day, the tariffs. So yeah, that probably is going to cause some more anxiety in the stock market. But let's see. I think I'm kind of looking at Navitas Semiconductor. I like the pricing on this. I like this company, and the other thing is that as we're talking about all this, about all the issues around international trade and international geopolitics, there is a lot that's going on in the economy in specific sectors, especially AI. I recently sat through, um, it's not going to be able to come up here, the GTC conference for NVIDIA, by NVIDIA, and they're down quite a bit. And there is a lot coming down the pipe in terms of new semiconductors and new chip architecture and new models of AIs. Of course, NVIDIA is going to talk all that stuff up. But Jensen Huang, the CEO of NVIDIA, made the statement that he thinks that we're going to need 100 times the computing power that we thought we needed 1 year ago. So their assessment from 1 year ago, today's assessment is that we need 100 times more, 100 to be 100 times faster with chip architecture, and we're gonna need the semiconductor architecture to go with it. Um, uh, and he's got it, of course, right? He's got he's got it coming down the pipe, so everybody get ready to buy it. So I'm really liking NVIDIA's price, even though it doesn't fit the strategy of the small caps. This is of course Mag 7, but this is a pretty good dip for NVIDIA as well. They're looking very attractive at these prices. So not so much for buying NVIDIA stock, but just kind of the overall dynamics around the economy. And the other thing is that this whole dynamic that's playing out with bringing production back to the United States, where'd it go? Yeah, over here, and all this going on, you have all these layoffs in the public sector, which is hopefully going to produce a labor pool that the private sector can pick up, because 4% unemployment rate is very low, which means it's going to be tough. It's going to be tough to expand production in the United States because there's not going to be probably enough of a skilled labor pool. So the labor pool does need time to transition, and it may have to reskill itself so it can operate in the private sector. But there, AI comes into the game, right? So AI could be a big player in creating efficiencies and productivities, and some of those metrics in the economy, which I won't get into right now, are actually positive. They're indicating positive that overall productivity and efficiency in the economy is getting better. But AI could make that even better, and it could address this unemployment rate on the private sector. Yeah, no, it's a general unemployment rate, private plus public, which is a bit of a concern, especially if you're looking to expand locally and expand local production. So that's that. There's that dynamic going on as well. So things can happen. Things can happen in specific sectors, in specific areas, in specific stocks, even with this very kind of broken up, very shaky, very fear factor, geopolitical, macroeconomic stuff going on, right? But um, personally, I think it's a good time to buy some stocks. I don't know if you probably, it's not something that one has to be done today or tomorrow. It could be a 1 week thing or a 1 month thing. I'm probably going to move sooner rather than later. Um, and yeah, that's definitely on the cards. And one thing I really quickly wanted to touch upon in this scenario, in this kind of where the portfolio is in stress. I wouldn't really call it stress. It's kind of at a low ebb. But kind of despite everything that's happened um, in the stock market and in the economy and in the political staging over the last month or so, right, which has caused a huge downturn in the markets. It's all interim. Um, Despite all that, our portfolio, right, which is these small caps, right, early life stocks. A lot of them rely on capital to fund their operations, so they don't have revenues and markets built up to the level that they can be fully self-supporting in that sense, and they can actually build up capital. They have to go out and seek capital, but they have good products, they have good technologies they're working on, and they're promising in that sense. They're high risk, and despite everything, we're still beating the major indices. So why is that, right? I thought I'll just quickly bring it up now. I did talk about it in the initial vlogs, but the reason for that simply is that we picked it up at a pretty low price point, where this particular portfolio of stocks was doing very well previously in 21 and 22. And it took us a pretty serious nosedive, I guess starting in late 2021, and then all the way over here. Whereas Nasdaq and S&P and Dow, if you look at them, they've been setting record after record after record, and now there is a correction, a pretty overdue, as well as a healthy correction. But if you had picked up that same price point over here, I guess would be somewhere around here, you would definitely be in the negative, right? So the price point at which you're entering a stock, right? If it's at a multi-year low or if it's at a multi-year high, the market was at a multi-year high, we were at a multi-year low, and we picked up hopefully some quality stocks, and that's why the portfolio is still, despite everything, outperforming the markets. And I hope it'll continue to do that, but we'll see. Let's see uh, how much it gets tested and how it gets tested. So I think I've covered everything and I've gone on long enough. I know I always do EV updates. Is there nothing? Yeah, there actually really is a really big deal in the EV industry, but it's not here in the United States, which is the market that I'm looking at, because I think there's a lot of growth still here to be had in EVs. But 5-minute charging has broken through. I talked about this as one of the anxiety issues that the EV industry has to solve, especially here in America before we go big mass market. Um, and it's happened in China. So China's really taking the lead in the science on this, and they apparently now have, as being reported, 5-minute charging on electric vehicles. And maybe that's good news. Maybe that's good news that we could have similar technologies being built out. At least now we know that the technology is there and it's commercialized and it's scalable and commercialable. um, and all that. So I think that's some good news as well. Uh, but yeah, I think let's wrap it up here. And well, very interesting stuff going on. I'm sure there'll be plenty to talk about how things move along with all this stuff and how they settle and where they settle. So plenty more to come. Okay. Thank you for listening. See you next time. Bye bye.